Good morning, everyone, and welcome to the Strategic Day Trader Open House. How is everybody doing? Sound check. Hey, guys and gals. Good to have you all. Thanks for coming over. Thanks for showing up. I know today is a holiday, so I appreciate you coming. I won't let you down. All right. I have a really important topic to cover that should also help you with the rest of the week. That's why I'm going to talk about gaps, because that's what I do, and that's what my assistants also do, Ifan and Ryan. So we thought, well, we don't want you to be lost during the week. Let's go ahead and give you a great introduction to gaps trading, which is, by the way, how I earn a living in the market, and I'll show you that later on. So the sound is good, pictures hopefully crystal clear. No sound? All right. Let's see. The problem is people don't read comments, so I just typed in what to do. But people often don't read comments when I type in what they need to do. But I am going to get started. Monica's here to help. So I'm going to go ahead and get started. Are there any questions for me before I get started? Are there any questions? Let me know. Let's see if you have any questions. Sound is great. Click camera. Okay, got it. Let's get started. So an intro to gaps, all right? Some general information. A gap is the difference between yesterday's closing price and today's opening price. It is based on the NYSE 4 o'clock regular market closing time and the NYSE 9:30 regular opening time, meaning pre and post market trading is excluded. For gaps purposes, pre and post market trading is excluded. All right. Gaps can create voids in the price pattern, or they can create overlaps in the price pattern. Let me show you what I mean. This stock gapped away from the chart pattern, creating a hole in the chart. See this hole? That's what we call a void. So when the stock gaps away from the chart pattern, it creates a void. When the stock gaps back into the chart pattern, see this little gap up right here, gapped up halfway through the red bar. When it gaps into the red bar, it creates, or into the chart pattern, it creates what is known as price overlaps. Between the two, we very much like voids more, because then you don't have support and resistance to deal with, and the stock can just take off. All you have to do is look to the left. And if it's old resistance, then it's not going to be that effective or that powerful enough to stop the stock from advancing. So overlaps or voids, all right? Now, but what is really a gap? Because almost all stocks gap every day, okay? Every stock almost gaps. Most stocks gap a few pennies every single day. We only want to track gaps that are considered significant. Gaps that are significant. Now, significant is not necessarily a certain dollar amount or percentage. It's a visual term. It is usually one of the biggest gaps that you see when looking at the daily chart. So if you look at the daily chart, it usually is one of the biggest, if not the biggest, that you can see without having to scroll back and look at past years. But usually daily chart should show you about 3 to 4 months worth of data. It should be one of the biggest gaps, but it really depends mostly on the pattern that the gap is creating. So it's not a certain percentage or a certain dollar amount. It is really more based. What matters the most is what kind of pattern the stock is creating. For example, if you look at this chart, see how this gap compares to prior gaps. Now let me take out my annotation tool so I can show you what we're talking about. This gap right here. This one, see it? Stock closed, when you have a red bar, the stock closes at the bottom of the red bar. So we had a 40-cent gap there, a 40-cent gap on an $8.50 stock. It's about a 5% gap, 5+. So how does this compare to previous gaps? Well, here's one other gap we can see that looks like it was bigger. And then maybe there's a little one here. But as you can see, it's one of the biggest oh, here's one. That's the biggest. It's one of the biggest that you see on the chart. But it also was significant because we didn't really clear the entire bar, but we almost cleared a wide range red bar, and the stock broke out. And look at the move, right? From $9 to $11 and then continued higher. So significant is a visual judgment. It is usually one of the biggest gaps, but it really depends on also the pattern that it's creating. It depends on the pattern that it's creating. Now, why stocks gap? Gaps are usually caused by news regarding that stock sector or the market in general, that the actual news does not matter. I don't even bother to look it up, okay? We don't even bother to look at it, with some exceptions. One, stocks that are the target of a buyout, which is a cash deal and a done deal, usually don't move much after the open because it's a done deal, right? Usually they don't move much after the open. Stocks going ex-dividend, when the stock is making a dividend distribution, they're not really gapping, they're just adjusting to the dividend distribution, will usually gap by the same amount that of the dividend distribution, right? So it usually gaps down to reflect that dividend distribution. So that is not considered a gap either. Secondary offerings, while they are real gaps, there is a tendency for these gaps to not move much or even get bought. For the most part, you are better off staying away. Secondary offerings, stay away. Stocks known as ADRs are American depository receipts and are not really gapping. They are primarily traded in a foreign market, and when the US market opens, they simply must open at their closing price overseas. Does that make sense? Now, how can you tell whether a stock is a buyout, ex-dividend, secondary offering? There are ways to tell easily without looking up the news. Again, you can usually tell without having to look up the news. When it's a buyout, it's usually a big gap on millions of shares, and it's not moving at all in the pre-market. When it's ex-dividend, the stock might look like it's gapping on the chart, but if you put it on a watch list or the level 2 screen to look at the percentage drop, it will show that they don't match. The chart might show it's gapping down 5%. You look at the level 2 or on a watch list, and it's not it shows it's actually up 0.5%, or it's down 0.5%, but it's not gapping. The percentage down does not correspond correctly to what the chart is showing. That's how you can tell it's an ex-dividend. Secondary offerings, usually the stock will gap down on millions of shares. But it doesn't have to be millions, hundreds of thousands, and it's not a huge gap down. It's just a small gap down on millions of shares, and it's not moving in the pre-market either. So that's how you can tell without having to look up the news. Stocks known as ADRs, it's easy because they trade in dots and spots like so. See this? That's Ericsson maybe, or Sony, and it's a foreign company. So if it trades in dots and spots, it's an ADR, should be stayed away from. It's not a real gap. Let me start my trading platform here. I'm going to show you a couple other things about this topic. Now, there are a lot of companies that are foreign stocks, but they are primarily traded in the US. So for example, something like, BABA. We know BABA is a Chinese stock, right? BABA. 1 second. But see, that doesn't trade in dots and spots. That's okay to trade, to day trade. Baidu, Chinese, doesn't trade in, whereas Ericsson, look at this, that's it gaps every day. Sony, gaps every day, doesn't move after the gap also. Fiat, very small bars, very small range candles these are. So those you really want to stay away from, because as I said, they don't move after the open, so you don't want to waste your time and energy, but that's not the only reason why you want to stay away from ADRs. Okay, we'll talk about more reasons as we go. Okay. Common terms you hear. Names for gaps: novice gap, professional gap, continuation gap. By the way, those are the three that you really should care about. That's it. Everything else, it's not that these are meaningless names. No, some of them are important concepts, but if you can understand the first three, then everything else, for the most part, is a subset, is a variable of one of these three. Okay, let me see why. Okay, so novice gap, professional gap, continuation gap, mortgage gap, gaps that bully, gap and snap, gap and go, gap and crap, exhaustion gap, breakaway gap, you know, ex-dividend gap, earnings gap, shock value gap, extended gap, overlapping gap, creating a void, significant gap, mega gap, breakaway gap, gap disease, island gap. Every type of gap does have some significant connotation, I would say, but again, is a subset of the first three. So if you can understand novice, if I can get you to understand the difference between novice, professional, and continuation today, then you'll be, then I'll have accomplished my mission, okay, for today. Now, professional versus novice. In a sense, everything we do with gaps is in search of determining if the gap might be a professional gap or a novice gap. Professional gaps are gaps that change the long-term, daily, weekly, sometimes hourly direction of the stock by gapping against the current direction. So if you were to underline this, professional gaps, okay, gap against the current direction. With current direction meaning the last day or two. Current direction refers to the last day or two. Novice gaps, gaps that also end the direction of the stock by gapping with the current direction. So in the same direction as the most recent bars. For example, if yesterday's bar was red, in this case a wide range red bar, and the stock was in a downtrend, and today the stock gapped up, we're talking about this gap right here, this guy, and the stock gapped up, that would be considered a professional gap. Gaps against the current trend. Current means the most recent trend, and continues in the direction of the gap to change the trend and sets the bottom for months to come. Huge gap up in a downtrend sets the low for months to come. Okay, that's a professional gap. Novice gap, down a lot, right? See this? Gaps with the current trend, but reverses the direction of the gap to change this trend. So this was down a lot and finally gapped down in the same direction and set the bottom. So big gap down in downtrend sets the low for days, months to come. All right. I am trying to keep an eye on the comments. Hopefully you guys are able to make it through and tune in. The VTF, the virtual trading floor, is a proprietary platform, so not a lot of people are familiar with how it works, and we always struggle just a bit on the first day of the open house. Okay, so that is true, but hopefully, you know, you're catching up, and we're just getting started talking about the difference between professional and novice gaps, which is really the most important thing when it's the first step when you're analyzing gaps? Is it professional or is it novice? Because if it's professional, you want to play with the gap. If it's novice, you want to play against it because the gap usually gets faded. Does that make sense? If it's professional, you want to play with it in the same direction. So it's a gap up, you want to play it long. Gap down, you want to play it short. If it's a novice gap, you want to play against it. So if it's a gap down, you want to look to play long. If it's a gap up, you want to look to play short, because novice gaps usually set the bottom or the top. Okay. You call these gaps out during the opening each day. I actually create a list in the pre-market and send it to the room at around 8:30 a.m. And then at 9 o'clock, I get on the mic and review the gaps list one by one, each and every one of them. And I create a favorites list, meaning just a handful of gaps that I'm looking to focus on. Okay. And then at the open is when I start trading them and calling out the plays. If you're going to be here tomorrow, you'll see how we do that. Okay. Now, since it's not always obvious what is bullish and what is bearish and what is professional and what is novice, we use an objective way to look at and score all gaps. Okay. For that, I thought I would just show you my gap. I have a strategy for each. I have a strategy for each. A strategy written out for each strategy that I do, right? Basically, a trading plan that I have for each type of trade that I do. I don't trade. I don't have a shoot from the hip approach, right? So every type of trade that I do must meet a certain strategy that is already well documented in my trading plan, and that has a certain criteria with specific entry, stop, target, management, reward to risk, relative strength, relative weakness, the market timing. Every little thing needs to be addressed. Now, I'm not trying to overwhelm you, but this is professional trading, right? You know, you don't go to a doctor and expect them to be to somebody that read a book about medicine and you know, and then give you a prescription or do surgery on you. You don't expect, right? Or somebody that you don't hire a lawyer that simply just read a book about law, or an accountant that is good with math, or you name it. Every type of professional needs some form of formal education, really serious education, and follows certain guidelines. And the same here. This is not a game, and I'm not a hype man. There's a lot of hype people out there. I mean, it makes me sick to my stomach when I see what people out there say and do. And this is not what we're about here in this room and at T3. So there's definitely some work that needs to be put in, some education that needs to be had, that needs to be taken, and then from there it's just about trial and error experience and a matter of refining and improving until you get to your sweet spot. And then once you get there, never ever leave your sweet spot, because the market doesn't change. The market does change a little bit. We go from bullish to bearish to sideways markets. Yes, summer doldrums, earnings seasons, the market does change, but I mean, human psychology doesn't change. So year to year, decade to decade, it's always going to be the same, with some, again, minor changes due to technology, due to current market environment. but human psychology does not change. So once you get to your niche, once you find your niche or your sweet spot, never ever leave that. Okay, I have trained and met a lot of people that just constantly kept jumping around. They would they finally learn gaps and they get really good at it, but they're not making as much money as they want to, and they say, well, what about this other strategy over here? What about this other guy that's claiming to be making millions of dollars yet doesn't show any proof, but just, he's a good talker, and what about him? Let's see what he has to offer. And they keep jumping around, and then they never really settle down. They never make money. Does that make sense? Okay, so when it comes to gaps, because it is hard, so let's go back to this. Since it's not always obvious what is bullish and what is bearish, and what is professional and what is novice, we'll be using an objective way to look at and score gaps. So for that, we use a 5-point system to rate gaps as follows. For professional gaps, we look at the short-term pattern. The short-term pattern meaning the last day or two, the last, just sometimes one day, sometimes multiple days. And if the stock we score it on a 5-point system. If it gets a point for each of those 5, then it's a perfect gap, a tier 1 or an A-rated gap. If it gets a point for each and every one of these 5 items. If it gets 4 out of the 5, then it's a tier 2 or a B-rated. So for professional gaps, the short-term pattern, a point is given to the short-term pattern when gapping above a wide range red bar or causing we're talking about a professional gap up in this case. Okay, gap up strategy. So a point is given to the short-term pattern when gapping above a wide range red bar or causing a significant failure on the daily chart, such as gapping over a sell setup, a base, or multiple red bars. So when there is some shock value, when there's some trappage, that's not a word, but when you look at the chart and you say, wow, people shorted yesterday and today the stock is gapping up, then you know, like here, red bar, and then the stock gapped up, then you know every single person that shorted it yesterday is trapped today, is underwater. Okay, that gives a point to the short-term pattern. Okay. Second, number 2, location. A point this is easy. A point is given when gapping above most recent resistance. Again, a point is given when gapping above resistance. So if you look at the stock and it's clearing resistance, gets the point. Easy. If it doesn't clear, it's not clearing resistance, it does not get the point. Gap size. A point is given when gapping just above resistance. So when it comes to the size, some stocks gap 5%, 10%, 20%. How do we know what is the correct amount? Should it be 5, 2, 3, 20, 50? What's the correct amount? The correct amount is, the ideal amount is when it gaps just above resistance. When it just clears it, doesn't gap way above it or gaps into it. We want it to gap just above it, not too far above it, because then it becomes a bit extended. And extended in this case doesn't mean it's far from the 20. It just means that it's likely to get sold. I don't have really great examples to show you at the moment, but think about it like this. Let's see, is there a stock I can show you? That has recently had a gap or whatever. Okay, let's just say the stock had a base and gapped here. Well, you might give it it might get the point for the short term. It might get the point for the location, meaning it's clearing resistance, but does it get the point for the size? No, because it gapped way above. In this case, it'd be gapping way above the resistance. Because when a stock gaps way above, you have to think about it like this. A lot of people will look to sell it. You wake up and your stock is up 10, 20%. Wouldn't you look to sell it? I would. So even though it might be gapping over a big red bar, right? Let's just pretend yesterday was a big red bar, clear the base, extremely bullish, but simply due to the size being so large, a lot of people will say, I'm going to take profit. So that the trapped traders that will look to cover might not be enough to propel the stock higher, because there's going to be a lot of people looking to exit on this large gap up. A lot of longs looking to exit. Does that make sense? Yeah, team, I guess, but team wasn't such a huge gap. It did get sold. Look, that's a good example, Stephen, because look, here it is. Here's the resistance. Right here at 96 bucks would have been good, but it got $4 bigger. So while it cleared 2 red bars, it was $4 too big. Now, really good example, Stephen. In the case of team, though, from Friday, it wasn't so big. It's just 4% too big. It wasn't so big that I would have necessarily anticipated it to get sold like this. So this was kind of a surprise that it got sold. The system that I'm teaching you here is not meant to be foolproof. Okay, there is no such thing in trading. It's probabilities, it's odds. I'm teaching you odds and probabilities, but I'm not teaching you a foolproof way that every single time the stock gaps just above resistance, let's just say, it gets bought. There's no such thing, right? There's no such thing. So in this case, it was a bit surprising that it came in this hard, but yes, that's a good example because it gapped a little bit, way above resistance. So good example. Good question, Joseph. A gap way above resistance does a gap way above resistance make the long-term pattern look novice? No, not necessarily, because if the stock is up a lot and then gaps up a lot, then yes, it makes the long-term pattern look novice. But if the stock, let's say on the larger trend, was sideways and then gapped up a huge amount, it still wouldn't make the long-term pattern look novice. Only if the long-term pattern was coming from an uptrend, in which case, in this case, it was a little bit, but it wasn't an extended long-term uptrend. So does that make sense, Joseph? So is team novice? No. Team was gapping over 2 red bars. It was an oversized professional gap that simply got sold. More than expected. I would have expected it maybe to come in a little bit, $1 or $2 or $3, but it came in $10. So more than expected in this case. Okay, what resistance were you considering? No, the resistance would be the candles to the left. So that is the resistance. Remember, the stock closed here, and then the next day gapped above. So that would be the resistance. Daily, yes. Always daily chart. Good questions, guys. Really good questions. What are my thoughts on day trading gaps? Well, I like doing that. If I wasn't, I wouldn't. If I didn't, I wouldn't be teaching you gaps. We wouldn't be talking about it right now. Is the gap measured based on the high or the close of a tick? Hey, Leo, no, I already said that, talked about it. It's measured as the difference between yesterday's closing price and today's opening price. So it's the difference between the closing price and the opening price. Got it? Okay. Are gaps used for swing trading? Yes. 50% of all my swing trades come from gaps. Can you believe it? 50%. Between, let's say, 45 to 50% of all my swing trades come from gaps. Not on the day of the gap. I wait for a pattern to form after the gap. 50%. Almost. Sometimes a little bit more than 50. Sometimes a little bit less than 50%. Isn't it crazy? So if you can learn gaps, you will have learned how to day trade and how to swing trade to some extent. It's a beautiful topic. And I'm not, again, I'm teaching this because that's what I do. That's what I'm going to be doing during the week. So what's better than to teach you, to give you kind of some prep work to prep you for the week by going over gaps. That's the best thing to do. Okay. How many entry patterns? Several. I mean, in this strategy, I have 6 in this strategy. For just the gap up strategy, I have 6. Okay, let's continue, please. Good questions. I don't mind stopping every little bit to answer the questions, but we don't want to get too far away from the current topic being discussed. So let's continue. So short-term pattern refers to the last day or two. If the stock gaps above, if the last day or two were red bars and we gap above them, then that we give the stock a point for the short-term pattern. Second point is location. If it clears resistance, it gets the point for location. Okay. Size refers to how much over resistance. If it gaps just above, then it gets the point for the size. If it gaps way above, then it loses that point. Okay. Number 4 is the long-term pattern. This is the hardest to understand. A point is given to the long-term pattern when gapping against the trend of the daily chart. However, this is not to be applied too strictly. Generally speaking, as long as the gap is not making the long-term pattern look novice, a point will be awarded. So the long-term pattern, it is best when the stock gaps against a long-term, against the trend on the daily chart. So you have a downtrend and you get a gap up. You have an uptrend and you get a gap down. Does that make sense? That's ideal, especially when it also breaks the long-term trend. Okay, when it breaks the long-term trend. Let me just take a look. This is, I think, something that I still remember. Actually, I have something better than this that I can show you. But here, see this? Look at this, guys. Long-term trend was up. The gap broke the long-term trend. That is the best. Now, this is not the best gap because we didn't have a green bar yesterday. If this was a green bar, then it would have gotten the point also for the short-term pattern. Let me show you a gap that had a green bar. Let me just show you. This is just from memory. I'm sure we have way more recent stocks. Here it is. But this is just from memory. Hasbro. Look at this. The last 4 days were green bars. 4 days in a row, right? Into earnings, and the stock gaps down. Not only did every single person, including Wall Street people, including you, me, every single person, novice, professional, smart, dumb trader, every single trader that bought it the last 4 days was now underwater, but it also was ending the long-term uptrend. The stock had been in an uptrend for months and months, and now this gap shocked the heck out of it. I mean, it ended, shocked everybody. The short-term traders that bought it anticipating the last few days, anticipating that the stock was going to gap up and do well on earnings, but it also shocked the long-term traders that have been in it for a long time by breaking the trend. That is the best type of gap, because in this case, it gets the point for the short term and it gets the point for the long term. Does it get the point for the location? Does it get the point for the size? We haven't talked about. I mean, we don't know yet. Let's take a look. Is it gapping? Location refers to support. Is it gapping under the most recent support? I would argue it is. It was, right? Is it gapping just below it, or did it gap to way below it? Let's say at 100 or 95, just below it. So it gets, so far, it got the point for short-term, location, for size, and long-term. And relative strength, relative weakness is the easiest to understand. A point is given whenever the market is gapping up, is gapping down, and your stock is gapping up, or when the market is even opening flat. The best type of gap, the strongest, is when the market is gapping down and your stock is gapping up, right? When the market is gapping down and your stock is gapping up, because then it truly has relative strength, a lot of relative strength, and it means people are stepping up and buying it. Wall Street is buying it despite the bearish market. What better message do you want? That's the best scenario you can get. Does that make sense? That's relative strength, relative weakness. So those are the 5 things we use to evaluate gaps. And if tier 1 gaps must have 5 points, tier 2, they get 4 out of the 5. Tier 3, tier 3 gets 3 out of the 5. You can replace the tier rating with A, B, C. A rated, B rated, and C rated. C rated would be the average everyday gap. A rated would be the, the best. B is solid, really good, but not perfect. Does that make sense? Okay. So now we talked about professional, we talked about the rating, we talked about the 5 things. Now, what about novice gaps? Can you rate them? Of course. Novice gaps, as discussed, as we said, is the complete opposite of professional gaps. Is the complete opposite. So for a professional gap, in order to get the point for the short-term pattern, it needs to be gapping up above a wide range red bar, right? For a novice gap, a point is given when gapping above a wide range green bar or 2 or more average size bar. Okay, so for a novice gap, we need to gap over a big green bar, which means the professionals got in it yesterday, and today it's just novice. Novice people are finally buying it because, oh, Tesla's report made the announcement for Model 3 car. Remember when that happened? Tesla had been running up for a whole month. They finally showcased the car, and the stock actually gapped up only to get sold hard. Why? Because buy the rumor, sell the news. Wall Street had been buying it for a whole month. When the news is out, there's no reason to be in it anymore. Now that the news is out, it gets immediately factored into the price of the stock. Novice people come and buy it because they're so impressed with the stock. Wall Street says, oh, let me give you my shares. And they sell their shares because they've been buying it in anticipation of that announcement. Once the announcement is made, there's no reason to be in it. They just sell it. Does that make sense? So that's why we say buy the rumor, sell the news, which is true in trading. There are a lot of sayings on Wall Street that are quite true, and some that are totally false. Another saying that everybody's heard before: the trend is your friend, and it is true. The trend is your friend until the end, right? The trend is your friend. So don't bet against the trend until it ends. Another false saying in this case would be, you can't go broke taking profits. Oh, sure you can, right? If you're constantly taking small profits and your losses are large losses, of course you can go broke taking profits. You can go broke taking profits on 9 out of 10 trades. If you win a little bit, and then when you lose a lot. I have a friend who during the financial meltdown in 2008 bought 5 stocks, and he had $30,000. I mean, he put $30,000 to work in the market, and he bought $15,000 worth of Netflix at $3 a piece, $3 a share. It was trading at $3 a share. So you do the math; it would be like worth over $2 million today. But Netflix went up a little bit. He sold it, and the 4 other stocks that he bought, 3 of which went bankrupt. So they went to zero, like literally went to zero. And then one of them is CSIQ, which is, I guess, still trading today, but it hasn't really done anything. Let's take a look. Since 2008. So yeah, I guess that one is working, but Netflix again, he went up, he sold it, and the other 3 he held until they went totally bankrupt, and so he's down money. I mean, I don't know if he still is now, but last time I spoke to him, he said he was down instead of being up $2 million. So you can go broke taking profit. So short term, a point is given when gapping above a wide range green bar or 2 or more consecutive average size solid green bars. Location. For a novice gap, a point is given when gapping into prior resistance. Okay? If it gaps into prior resistance, it gets a point for the location item. Size, a point is given when gapping an excessive amount without becoming a mega gap. What's a mega gap? A mega gap is a gap that gaps above all reference points by a lot. Team, for example, was not a mega gap, even though it gapped above all reference points on the chart, all-time highs, but it gapped just a little bit above, 4% above or 7%, 6% above. It didn't gap 20, 30% above. When it's such a big gap, that's called a mega gap. And it makes most gap strategies null and void. Mega gaps make most gap strategies null and void. There's a way to trade them, by the way, but we're not going to go over that right now. Long-term pattern, a point is given when gapping in the same direction as the long-term, as the trend, in the same direction of the trend on the daily chart. A point is given when gapping in the direction of a long-term uptrend, one that's preferably extended to the upside, because then it makes it novice. Relative strength, a point is given when the market is also gapping up. Conversely, a point is taken away if the market is gapping down. So let's compare and contrast with professional gaps. So for a professional gap, in order to get the points for the short-term pattern, it needs to be gapping over wide range red bar. Okay? Or 2 or more average size red bars. For a novice gap, it needs to be gapping over wide range green bar or 2 or more average size green bars. For location, for a professional gap, we need to be gapping, we need to be clearing resistance, gapping over resistance. For a novice gap, it gets the point if it gaps into resistance rather than above resistance. Size, for a professional, it gets the point if it gaps just above resistance. For a novice, way above without becoming a mega gap. So for a professional, we don't want it to be excessive. For a novice, we want it to be excessive. Long-term pattern. For a professional, we want it to be gapping against the long-term trend, ideally breaking the long-term trend like I showed you on HAS, on this one, on UTHR, breaking the long-term uptrend. For a novice gap, we want it to be gapping in the same direction as the long-term uptrend. Okay. Relative strength, relative weakness. For a professional gap, we want it to be gapping against a down market. Market is actually down and your stock is gapping up. That's ideal. Or gapping up while the market is opening flat. For a novice gap, we want it to be gapping in the same direction of an exuberant market. So we want the stock to be, the market to be actually, partly at least, causing the gap in the stock. Does that make sense? So that if the market comes in, it falls with it too. That there is no catalyst for the stock to gap except for the market itself, maybe. Okay. Some notes, I guess. The following gaps are considered not playable. We talked about that. I'm not gonna. There's 4 pages of this. Upgrading entries. How do you upgrade entries? Because in theory, only gaps with no major flaws are playable in the first few minutes at the open. However, tier 1 gaps are rare, and limiting one's trading to tier 1 gaps will virtually guarantee missing the open most days. How do you upgrade? How do you enter, stop? Where do you put the stop? What kind of entry patterns do you use? What kind of management? So there is more to it, a lot more to it than I'm going to be able to go over right now. But I'm trying to get you to a level of understanding so that you can follow along tomorrow and the whole week. Okay? Any questions so far? Are there any questions? Let me know. Do you prefer to trade options or the actual stock? I prefer to trade the actual stock. Okay, options are good for leverage, but I don't need the leverage, and are good for limiting your risk when you're trading overnight. But if you know what you're doing, for the most part, options are useless for me. Will your notes be available for us to download? They will not. They will not. What else? Anything else? Are entry patterns different between gap ups and gap downs? No, they're not. They're not. Do you trade one stock at a time, or do you manage several positions? Most of the time, especially at the open, you can really only trade one at a time. Now, if you get into a play and it starts to go in your favor, then you can move on to something else and just put your stop in the system. Yes, I can trade more than one at a time, but can I enter more than one at a time? Probably not, right? But you only need one. If you can catch one, just one, then that's all you need for the whole day, probably. Okay, so usually not more than one at a time, but sometimes we do catch more than one. When considering resistance, how far to the left do you need to look? Just the most recent resistance. So if we were to look at an example, let's say, this one. In this case, it was a gap down. Where is the most recent support? You look to the left. If there's nothing to the left, then you go further. Like, let's go. This is easier, maybe here. Here. Where is the most recent resistance? It's this resistance. Is there more from previous years? Was there more from previous years here or there? Yes, but I wouldn't look further to the left. Always look to what's immediately to the left. If there is support, then you use that. If there isn't, then you can look further to the left. This is a big thing, by the way, that most traders misunderstand or don't know how to do, which is they're constantly trying to analyze by going. They look here and say, okay, there's that support, I see it, but then what about this support? No, it's useless. It's already been dealt with if there was any support there. You only want to look to what's immediately to the left. That's the most relevant information, the most recent. And then the old the data is traders from last 2 months, they're long gone, right? And number one. Number two, it's dealt with. The support has been neutralized most often. How long do you stay in a trade? Some trades the whole day, some trades seconds, and some other trades minutes. So it depends on the type of trade that I'm doing. Sometimes it's just a scalp. I know T3 sent out my most recent video. I do videos for really members of the room as educational, continuing education, right? And also for others that are not members, so they can get to see what I do and what the room is all about. And the most recent video was the one about PCG from last week, from Monday and Tuesday of last week. Traded it 2 days in a row, made over 25K. Okay. So a lot of those trades on PCG were, I was in them for literally a minute or two. That's it. I was in the stock because they were scalps off the level 2. Sometimes I'm in the stock the whole day, almost the whole day, or half the day, or 2 hours at a time, or 1 hour at a time. So it just depends. Okay. Does time of day affect the gap trade? Yes. In the morning, it's purely based on the gap, almost exclusively based on the gap. Later in the day, you have to analyze the multiple time frames, the market, the intraday trends, the relative strength, relative weakness, and the effect of the gap kind of wears off later in the day. So you really do have to pay attention to what's happening to the stock on an intraday basis. Versus at the open, there are no trends. So if you get into a position shortly after the open, it's you're basing your decision purely based on the gap. How many trades did you do? Like, I don't know, 20 plus. Stocks crash down and not up. Does it make it easier for you to trade on the short side? Good question, Sam. Yes, it's easier to trade when the market is down because fear is a much stronger emotion than greed. And so when people are panicking, you can easily take advantage of that. Basically, I hate to sound like a horrible human being, but it's true. When the market is moving up, everybody is making money. No panic, no fear. You can still make money by focusing on the unique stocks, but you're not going to get these really big moves usually. And so, does that make sense? So, fear is a much easier emotion to take advantage of than greed. Okay. And again, I'm not trying to sound like a horrible human being, but it's true. Let's see. Do you try to leave trades overnight? I do if it's a swing trade. If it's a day trade, I close the trade by 4 o'clock. I mean, I have to be out of the trade by 4 o'clock. I don't usually I don't turn day trades into swing trades. Almost never. Almost never. How long do you wait after the open before you enter? The first entry could be at 9:31, so 1 minute after the open. I could be in a stock. It depends on whether the quality is there and whether I get the entry that I'm looking for. So it depends on the quality and the entry. When is a pro gap a long-term trend? Paul, is a pro gap a new long-term trend? When is a gap? I don't know what that question means, Paul. Like, this gap resulted in a long-term downtrend. See this, Hasbro? Down, down. Look at this. See this? So that was the beginning of a long-term downtrend, but I'm not sure I answered the question. Do you hold a losing trade? How long do you hold a losing trade? The moment I suspect. So here's a big one. The number one reason why traders lose money is because they wait until they are 100% sure about a stock before getting in it. For example, we'll just use the Tesla example. They wait until Elon Musk showcased the car, and then they like it and they say, okay, now I'm gonna get it. I like the car. It's too late. You should have done your research already. Once it's obvious to everybody in the world, then it's too late to get into that position. You don't wait for the stock to go from $5 to $100 and say, you see, I think the stock must be bullish. Let me buy it. Now it's too late. Okay. Similarly, when the stock is going against you, you don't wait until you are 100% sure that you are wrong about the stock. It drops from $100 to $5. You say, yeah, I guess I think I was wrong about this stock. It's not really going to be the next Apple. Let me get out. It's too late. So the formula is you have to get out the earliest moment you suspect that you were wrong. At the earliest moment when you suspect you were wrong. Now, does that mean you just, as soon as your gut, you get that gut feeling that you're wrong, you get out? No, not necessarily. You have to analyze support and resistance, to analyze the market, the kind of stock that you're in. Some stocks, if they don't go immediately after I get in them, then I get out, and I tell the room, get out under the bid, just get out. Some stocks, you got to give them the wiggle room till they get going, and then you can raise your stop. But there is a place to put the stop. There is always a stop in mind, and you often in the system, an actual stop order in the system before the moment I get into a trade. So what I'm trying to say is I always know where I'm gonna get out. Okay, I always know in advance. This way I can manage it. Lots and lots of questions. What is a low amount for an account to take advantage of your system? you do need to have $25,000, I think, to be a day trader. Otherwise, you will trigger the pattern day trader, and that's the minimum amount that you can have in your account. 25. Usually you want to give yourself a little bit more. 30 maybe would be kind of at the low end. Now, do you need to have hundreds of thousands? No, I mean, I really don't need even 100,000. I usually like to keep just 100 or more, but I don't even need 100. I don't even need 100. I could do with 50. I could. Okay. I always feel like MMs are hunting for my stops as I get taken out, and then the stock moves in the intended direction. Then adjust. Then make, if that's how you feel, then make a change so that you don't, it's not the same always. Do you play full size when entering? I mean, most of the time, yes, I try to get in full size. Sometimes I may not get filled the entire share size that I'm trying to get because the stock is on an uptick or it's spready or, okay. A lot of examples are high price stocks. No, that's not true at all. A lot of examples that I've shown you are low price. I don't like the high price stocks at all. My preferred is, my ideal range is between 20 to 40, I would say. Even 17, 15 to 35 would be the ideal sweet spot for me. I hate high price stocks. I don't trade them. Tesla made $500 on Friday, $4.99 to be exact, after commission, after everything, net. So I did trade Tesla because it was moving so much. I actually missed it on the short to the downside, but I traded the bottom long. But I almost never trade Netflix, Tesla, Google, Amazon, any of these stocks because they're high priced, they're spready, they're jumpy, they can move a lot. If you just sneeze, you blink, and then it goes against you quickly. So I don't really trade these. Of course, they're good for trading options, but that's about it. Okay, let's see. Let's continue. I know there's more questions. Do I use VWAP? I don't. I mean, there's more questions, but I guess you guys are very curious, which is great. But let's take a break, and then we'll come back and pick up the thread, talk about fallacies, about gaps. It is 11 o'clock almost. Let's take a 7-minute break and be back at 11:05. 11:05, everybody. Hey guys, I am back. Sound check. Sound check, please. Okay, good. So far, my friends, we talked about, give you, I think, a good, solid introduction to gaps. Now, we're going to talk about fallacies, but I want you to keep in mind that you're never going to be proficient at anything if you stay at the surface level, meaning if you don't dig deeper and really, really become an expert at whatever topic that you're trying to understand and trade. You don't become a doctor by going even to medical school, which is really, really tough, and it takes years. 6 years if you're if you're a specialist. 12 years could take you up to 12 years if you're trying to specialize. You still have to do your residency, and you have to get hands-on training, and right. So you don't become an expert. You don't become an expert artist by. So you have to keep going at it. And the same here. I'm trying to just give you an introduction, enough information for you to keep up this week. But we do have a class called Advanced Gap Strategies online that you should really, really strongly consider if this is a topic that you want to become proficient at, and something that you really want to trade, and you like my style and what I do, and my results, right? So just just keeping it real and letting you know what I would do if I were you. Okay, fallacies about gaps. Some fallacies for you. Here's 4. There's more in the Advanced Gap Strategies class. There's actually more, but these are just some of the 4 of the most common fallacies. All gaps tend to be filled. A gap up is bullish and a gap down is bearish. The news helps determine how bullish or bearish the gap is. Really big gaps are extended and tend to fill. Let's tackle each and every one of these 4. Again, in the actual class, there's more, but I'm just trying to share with you the 4 most common. See this gap right here? Maybe this gap will get filled someday, but traders who are betting it will fill will not be around to see it. They'll be broke. See this, guys? And I can show you stocks that gapped. Well, I'll show you here. Why don't? Well, this one. No, there's just one example here. I've seen stocks gap from $1 to $2 to $3 and went to 20 and 30 and 100. Okay, so you can't. That's totally novice mentality when you think all gaps tend to fill. Yes, maybe eventually they will, because gaps go in cycles. That's why, right? Stocks go in move in cycles. So yeah, maybe this gap here this gap, let's just say here, will eventually get filled, but you won't be around to see it happen because you'll be broke, right? So that's first fallacy. A gap up is bullish and a gap down is bearish. This gap was not very bullish. You need to look at the whole pattern to determine what is bullish and what is bearish. This gap up got sold. Most large gap ups, by the way, just a kind of a tip. Most large gaps on low price stocks get sold. Most large gaps on small price stocks get sold, just in general. The news helps determine how bullish or bearish. The news on this one could not have been better for this stock. The company was able to report above expectations as cost-cutting efforts offset revenue growth. It was certainly a surprise, and what this shows is the cost-cutting initiatives at the beginning are taking effect. And yet the stock got sold. Have a discussion about why news seems to work to the novice trader? Well, news seems to work because anything is justified after the fact when it works, and when it doesn't, it's forgotten completely, right? So that's why news is usually, the issue here is timing. We're not saying this is bad news. This was bad news. We're not saying this was bad news that the company reported above average, exceeded expectations. I'm not saying this was bad news. I'm just saying that the stock was getting bought already, got bought ahead of the news. So if it already got bought, it means that the news was already expected, factored into the price of the stock. So when it gapped up, this was more of a short than a long that day, even though the news was truly positive news for the company. Okay? So the issue here is more about timing than trying to actually read the news in absolute terms, meaning the news was bullish, was positive, was good. Use any word you want. But in this case, based on the chart pattern, it was actually novice because the stock had already gotten bought prior to the earnings report. Remember the Tesla example that I gave you when they released Model 3? The stock had been getting bought for a whole month. And then when they showcased it, it got sold. Not because the car was ugly. It wasn't ugly. Everybody was impressed with it. Okay? All right. Really big gaps are extended and tend to fill. Check this out. From 332 to 1089, more than tripling the price overnight. Was it extended? No, it's not. Extended is a visual description, but a worthless term in trading. So what does extended actually mean? Does anybody know? A lot of people use the word extended. You know what other people say also for when they're trying to say extended? They also say oversold or overbought. It's a useless term in trading. Overstretched. How far from the MA? But look, I mean, it couldn't have been farther, and yet it still went higher. It gapped from 332 is where it closed the previous day, and then it gapped to 1089, more than 300%, and still went up the day of the gap, the day after the gap, and then based, and then went up some more. It doubled again. It went to 22 before topping out. You know why? Does anybody know why? Because when a stock gaps, you're not using up buyers. It just gaps there. It opens there. It would have been extended if the stock had run up without pulling back. Then yes, you would have been, in order for the stock to go up, you would have needed the buy. You would have needed the fuel. The fuel in this case is the buying. Does that make sense? So but when a stock gaps, you don't use up any of the fuel. It just gaps. Does that make sense? It's like driving a car from West Coast to East Coast. You need you need gas. Or if it's an electric car, right? It needs to be charged. The batteries need to be charged. But what if you transported the car? You towed the car. Did you use up any gas? Did you use up any fuel? No, you didn't. Then then the tank is still full. The same here. When it gaps, it's like transporting a car, towing a car. When it rallies up there, it's like using up the fuel, driving the car. That's the difference. So gaps don't cause exhaustion unless they're novice. They or extend. I shouldn't say exhaustion. Extension. They don't become extended because they gap. Okay. They don't, because you don't use up the buyers. All right, good. If a stock doubles in price, the PE ratio and many other fundamental numbers double, but none of this matters. On a short-term basis, it doesn't matter. For day trading, it does not matter, okay? From a technical view, extended up means we have exhausted all potential buyers. How many buyers does it take to make a stock double in price? None, or one maybe? None. I mean, the stock can just open up without using any buyers at all. Does that make sense? It's a big concept. David, apologies if I missed it. What indicators are you looking at? Good question. The three things that I have on all my charts are price, as depicted by candlesticks, because candlesticks are easier to read, and then Western bar charts, moving averages, the 20 and the 200, the 20 and the 200, and volume. That is it. I don't use any other indicators. Price, volume. Price tells us what's happening, whether the stock is going up, down, sideways. Volume tells us how the level of interest, how much interest there is in the stock, volume. And moving averages smooth out the trend. It's a directional tool that just basically kind of gives me, it expedites and makes it easier to analyze trends quickly, because it just points up, down, right? And there are other uses for moving averages. I did a couple of videos on how to use the 20, how to use the 200 period moving average. So if you want to watch these, they're out there. They're on the website. If you're also, let's see, do I have a list here? 1 second. You can also follow us on Facebook and YouTube. Let's see. I think this is the playlist, but I'll just double check. Let me just double check real quick. Yes, you can follow us there for more videos. Okay. Isn't price and volume already provided? Price and volume already provided. I don't know what that means. You mean, are they already part of the charts? Yes, most charts come with price and volume. How do you decide to take 2,000 shares on PG&E? Because I was scalping it, so it was, and I was basically risking per position no more than $100. Let's see, what time frame used for moving averages? 20 and 200 on every time frame. On every time frame. So 1 minute, 2 minute, 5, 15. Let's see. Okay, so tons of questions, but let's keep going. Let's keep going. Review and quizzes. Let's do some review. Assume the stock gaps to the blue line. How would you rate this gap? Assume the stock gapped to the blue line. How would you rate it? Now, first, was it professional or novice? Pro or novice? Matt, yes. Matt, yes. Pro, good. Let's see. Pro, and then as far as tier rating, tier 1, 2, or 3. 1, 2, or 3. I do know that that there are a lot of strategic day trader members in here right now. Not a lot, but some of you are familiar with this because you're in the room with me every day. Tier 1. Okay. Here is how it played out. See how it played out? Pretty nice. Tier 1 is the correct answer. Tier 1, the correct answer. If you've seen me talk about this before, please don't participate in the Q&A. If you've seen me go over this review before, please don't participate. Assume the stock gap to the blue line. How would you rate the gap? No, pro or novice? Yes, thank you. That's the first question really I want to get across. Pro or novice? Novice, novice. Anybody else? Novice. And you would be novice. Wow, you would be wrong. It is pro. Okay, novice means we've exhausted most buyers for the stock. We've exhausted all potential buyers. That's what novice means. It doesn't mean that every time you see a green bar and a gap up, that's novice. If that's what novice means, I could have finished reviewing. I could have finished going over gaps in 2 minutes. Green bar, gap up, novice. Red bar, gap down, novice. That's not, but that wouldn't be true at all. Novice means the stock is up a lot already and then gaps up. So in this case, the stock was going sideways. In fact, what is happening with the stock, guys? Ran up and then went sideways. Check it out. Check it out. Went sideways. So, and notice the moving average starting to curl, to point up. So the stock is, consolidating. In other words, it's about to transition back up. I did a video also recently, tons of great videos if you want to check them out. And I said, I don't know what the title of the video was, but it's about corrections. Stocks can only correct through time or price. When they correct through time by going sideways, that's a sign of relative strength. Yes, that's it's not a transition A, but it's a transition. Here's how it played out. The day of the gap, so this was pro. The day of the gap, somebody said it needs to clear the pivot. Absolutely, it didn't. That's why it didn't go anywhere. The day of the gap. So it had to absorb that supply or resistance from here. That was here, right? So that's why it didn't go anywhere. But then after that, it continued higher. This was bullish. It's just the gap wasn't tier 1 or tier 2 even. It was a tier 3 gap because it gapped. So why tier 3? Because it didn't get the point. It didn't get the point for 3 different things. For shock value, it didn't. It didn't get the point for the location. It didn't clear resistance. And then if it doesn't get the point for location, it never gets the point for the size. Do you see what I mean? So it didn't get the point for 3 different items. So this was at best a tier 3 gap. Okay, next. Stock, assume the stock gaps to the blue line. Pro or novice? First, was this pro or novice? Novice. Anybody else? Thomas? Let's see, pro, novice, pro, 50-50 so far. Pro. So let me show you how it played out. Okay, let's just say pro. I'm getting 50-50 almost. 50% of you are saying novice, 50% of you are saying pro. Let's just say this was pro. How would you rate it? How would you rate this kind of gap? Actually, what's the name of this type of gap? Anybody know? Anybody know? This is called a bullish gap surprise. A bullish gap surprise. But it didn't clear. For a bullish gap surprise, it doesn't even need to clear the whole bar. You just need to clear at least 50%. When it can't, look, it dropped from $15 to $10. It lost 33% of its value in 3 days. And it can't even clear 1/3 of yesterday's bar. So even though this was a professional gap, when they can't even clear 50% of the prior day's range, I do not, they get sold. I don't get involved in these. They get sold. Now, that doesn't mean I'm going to short them because, again, this is a pro gap. Anytime you have a red bar and a gap up, that's pro.
Again, anytime you have a red bar and then you get a gap up, that's pro. But as Thomas said, badly rated. I mean, poorly rated, whatever, right? Not a good pro gap. No, I wouldn't short this gap because it was pro. I rarely short pro gaps. Okay. Assume the stock gaps to the blue line. First, pro or novice? And then how would you rate it? Pro or novice, and how would you rate it? Anybody? Yes, I just told you a minute ago, right? Pro, 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 pro. Good. Excellent. I just told you a minute ago. If the previous day was a red bar and you got a gap up, it's pro. It's just a matter of, is it a good pro or a bad pro? How good of a pro was it? So now my question to you, how good of a pro gap was this? You guys all got it correct. You scored A, all A on the exam. How good? Tier 1, Tier 2, Tier 3. What do you guys think? Tier 1, Tier 2, or Tier 3? Feel free to participate. I don't bite. This is just, this is not for you. I'm not trying to catch you here. Or feel free to be wrong. It's not, it's only to help. Exactly. Tier 3, Tier 3, Tier 1, Tier 2. Okay. It is true in this case. It is true in this case that this was hard to rate because it didn't clear. So when a gap doesn't clear resistance, it's a little tough because then it doesn't get the point for location, it doesn't get the point for the size. But you also have to understand what's happening with the stock. When a stock is about to transition, this is what happens. First, you have a declining 20, and then it starts to flatten out. See this? It starts to create a base, and then it goes back up. And in this case, the stock broke down the previous day, yesterday, it broke down to new lows, closed at the lows on solid volume, and the next day, that breakdown, and you can see the moving average starting to curl up, was rejected. That breakdown was rejected. So this was a pretty good gap, a breakdown failure, and a transition A on the daily chart. Does that make sense? Does that make sense? Why it worked the way it did? And if we come across this exact type of gap this week, I will still look to play it really aggressively. I'll still say doesn't score really high, but I would upgrade the gap and treat it as a tier 1. Because this stock it caused a breakdown failure, and I can see based on the moving average, based on what the stock was doing, it was trying to transition up, transition higher. Okay. Could we have turned it into a swing? Exactly. That's a perfect question. Yes, because this is the only time when I hold something overnight, but I don't actually do it in my day trading account. In my swing account, that's also gapping, is when the gap is triggering a transition or a pattern on the daily chart. So this gap was actually triggering a transition. So this is exactly the type of gap that I would hold overnight. Okay, good stuff. Wow, you guys are impressive. Assume the stock gaps to the blue line. Pro or novice, and how would you rate it? Pro or novice, and how would you rate? Pro, novice, pro, tier 1, tier 3, pro 3, novice, pro, novice. Okay. Still not very clear, huh? Novice too much. All right. Pro 1, tier 1. Okay. All right. I will tell you the truth. This was not an easy one to read. Not an easy one to read. But let's first get things, let's make sure we're on the same page. This was not a novice gap. This was not a novice gap. Okay, number one. Number two, anytime you get a stock that gaps from the 20 MA, see this, the day before it was at the 20 period moving average, gapped up from it, it is not novice. It's rarely, if ever, is it novice when it gaps from the 20, because it means it wasn't extended before gapping. But what did I tell you also earlier this morning? I said large gaps on low price stocks. What did I say? Complete, fill in the blank. What did I say? Large gaps on low price stocks. What did I say? Get sold. Didn't I say that? Didn't I say that? They get sold, and they got sold here. So the analyzing the gap will give you will stack the odds in your favor. Absolutely, 100%. But you can start to also figure things out that fall outside the norm. Even if this was a highly rated gap, I know from experience, from observation, from all these years of trading gaps, that large gaps on low price stocks tend to get sold. So I would be very careful playing it long. Does that make sense? Whether it gets a tier 1 rating, tier 2 rating, of course, this didn't get tier 1 rating. You have to have a big red bar the previous day to get a tier 1 rating, obviously. So definitely not. But okay. But I know that also large gaps. Was this a large gap from $3 to 4, above 4? That's, heck yeah, that's 33% on a low price stock, on a $3 stock got sold. All right. Okay, right here. Grant, I can't, let's see, can you please point out and show how the points are accumulated? I already did that. I'm not going to go back to that if you don't mind. I already spent about 20 minutes on it. So earlier, I'm not going to go back there. Pro and, so pro or novice? Pro or novice? Pro. Pro. Okay, I'll just tell you. Pro. Pro. That's correct. How good of a gap? Tier 1, tier 2, tier 3. Eric says tier 2. Matt, tier 3. 3-ish. Thomas. I would not short this gap. Okay. Tier 3, tier 3, tier 2. Guys. Stocks correct through time or through price? Through time or through price? When it's through time, it's bullish after run up, really bullish. The stock tried to break down the previous day, big solid red bar, and the next day rejected. Every single person, every single trader, hedge fund managers, small time traders, big time traders, every single person that shorted it yesterday today is, what's the word? Fill in the blank. Is what? Get used to this word. Add this word to your vocabulary. What is it? Is trapped. Correct, Matt. Trapped is a loser. But let's use the word trapped. If you trap a cat in the corner of a room, what's the result? Try and trap a cat, just a cat. Oh my God, it would scratch you up. It'd kill you. A cat, little cat. You're in trouble. You'll get scratched up like crazy. Just a little cat, little kitty. Trap a bunch of hedge fund managers, 5,000 people, right? The next day they're buying it. They're covering their shorts. You go to sleep and maybe you're up, if you're a hedge fund manager, you're up $50,000. You wake up and you're down $500,000 or 200,000 or three. How are you feeling? You're just a small, maybe a manager in working for a hedge fund. Now you have to walk into the office and tell your boss, I shorted the stock expecting the news to be bad. We were up 50,000 today. We're down 200 right at the open. How are you feeling? You're going to be looking to cover right away. And add to it the other small time traders that are in it short. They're going to look to cover, especially when, and as some people won't cover at the open. They might think, oh, I'll see what happens. The stock starts to move up. You're down 1,000. Now you're down 1,500. Now you're down 2,000. Now you're down 2.5. How are you feeling? The pain is getting, and you get to the point where you just get out. So it starts that snowball effect, right? It starts that snowball effect, and eventually everybody ends up covering and the stock moves up. As a trader, you want to take advantage and buy this stock long, right? Okay, good, good, good. All right. Is this the last? Pro or novice? Assume the stock gaps to the blue line. Pro or novice? Novice, novice, novice. Novice, novice, novice. Okay. All right. Okay, let me ask you this. Let me ask you this. Now, remember I told you it's not as simple as green, gap up, novice, red, gap down, novice. It's not as simple as that. So let me ask you this. What is happening with the stock? Look at the moving average, how helpful it is. What is happening with the stock? Up. It's consolidating. It's kind of transitioning back up. If you get a wide range green bar the day before the gap, and then you get a gap up and into a strong resistance like this, for sure you can't play it long. And for sure this would be short-term novice, or novice-y, as I like to call them. Little novice-y gap, for sure. Novice, not pro. But it's only short-term novice because the stock, the larger picture, the stock was transitioning, right? The stock is really bullish. So yes, it took a day to deal with resistance, came in a little bit, but then eventually went higher. Remember this other stock we looked at that gap to resistance, but was also transitioning? Where was it? It was kind of one of the first few, this one. It took a day to deal with resistance. It didn't come in at all. It wasn't novice at all. And then it took off, right? Well, this was similar, but more novice because, and stronger resistance too, because yesterday was a big green bar. It went from 10 to 12, 20%, and then gapped up another 10%. So yes, this was more of a novice, but short term only. Long term was actually pro. Let's see. Okay. Assume the stock gaps to the blue line. How would you rate this gap? No, first, pro or novice? Pro or novice? Pro, pro, pro. Wow, you guys are pro. Look at you, acing it. Pro. How would you rate it? Tier 1, 2, 3. Tier 1. Island reversal, tier 1. Tier 3. 4. There's no such thing as 4. Tier 3, tier 1. 1. Okay. Well. Remember I said you stack the odds in your favor, but it's not a foolproof way of reading charts. But also, it was gapping to the 200, to the area of the rising 20. The stock is bullish. I'm not saying I could have totally predicted this, but I've seen it happen many times before, where the stock gapped under a big green bar and it looked pretty bearish, but right to support, right to the 200, right to the 20, and it got bought. Remember, we play odds. Anything can happen. What's your second line of defense? So let's say we thought this was pro and lower, and we were looking to short it. What's your what is always, so, and we were wrong. What is always your second line of defense? What is your second line of defense? Is your stop. But let me ask you this. Even if you misread this, why was it not a stop out? Why was it not, should it have, why was it not a stop out? Anyone? Because it went right up, right at the open, went up, never dropped. So it never triggered short. Exactly. Who said that? Tiago said that, right? Never actually dropped. So it never triggered a short. And this is a big one. Matching the correct entry to the type of gap is critical to your success and is the missing piece of the puzzle for many traders, even after they understand gaps. Is the missing piece of the puzzle. And I have to say, I am not going to go over gap entries and management and target picking and where to place your stop. Somebody just asked about it a minute ago. I'm not going to go over that today. That would be an overkill. I just wanted to give you an introduction, and I trust that I did do a fair job of giving you a good, solid intro to gaps and gaps trading. Okay, but you have to pursue it more. You have to take it a step further. As I said, we do have a class called Advanced Gap Strategies. You can find it on the T3 Live website or contact your counselor if you're interested in pursuing this more. But I hope I was able to give you good enough of an intro so you can follow along in the next, the rest of the open house. Now, let's see. Any other questions? Any other questions? Stock transitioning, what are the signs? How can you tell the stock is transitioning? The moving average was curling. That's the easiest sign to tell. See how the moving average is starting to point up. When the stock is transitioning, it looks more, it's a cycle. So it comes from a base and then starts to go back up. So that's one of the signs. It's a big topic, honestly. Okay. Great presentation, something we can use. Great. What percentage return you are looking to make daily, Jesus? Whatever I can make, as much as I can make. Remember I told you at the beginning of the presentation, I am not a hype man. I don't claim to make millions and also not show you proof. Anybody that claims to be making millions and doesn't show you proof, 100% of the time they're lying. Otherwise they'd show you, right? So I do a good amount. I mean, I make a good amount of money, but I'll log into my account live. Does it get any more fair than this? How about but let me just move this out of the way so that to make sure, so we'll log into my account live just to show you what I do, but I just need to move it out of the way so that my address is not showing and all of that stuff, all that, So I opened this account. This is with T3 Securities. Open this account in October of this year. October 9th was my first trading day. So if I were to go to September, for example, 2018 and search, but I need to move it out of the way for a minute just so to make sure here it is. Just want to make sure. So October, you're not going to see any trading. So I only started so if I were to go to June, for example, 2018, there's nothing, right? So let me see when my address is where, to the left is where my address is. Okay, there it is. That's all I can show you. Yes, that's all I can show you. There's nothing, 100,000, 100,000. So I opened it in October 2018. I moved my trading account with 100,000 with T3 Securities. 100,000, 103. I earned $3 in interest. At the end of the month, 147. So from trading gaps, mostly 99% of my trades, 90%, $47,000 net in October 2018, right? November 2018. This is live. From 147 went to 193. So net realized P&L is 52. Net $52,000. December was like the slowest month of the year. I mean, it was by far. It truly was. But I'll show you December too. Why not? December 193, to 136. I had a withdrawal. It's getting too big. I'm wasting the money by not. I invest whatever money I don't use. I put it in a. I put it in a real estate fund. Actually, it's in New Jersey. Earns double-digit interest, basically, or returns every year. So I had a withdrawal. How much did I make? Net $20,000. December, slowest month of the year, 19,900. You saw my video just from a couple of days ago, from this week, last week, Monday, Tuesday, 25K for January. So if I were to go to January, it's not going to show yet. January 2019, it's going to say, I can't show the statement yet, not available. Okay, but that's, again, you do the math. That's not, I don't claim to be making millions, but I make a good living, to live. Let me show you. Can I show you? 1 second. I'll be right back, okay? I'll be right back.